Welcome, my friends. The news today is that credit card losses are rising at the fastest pace since the great financial crisis. Goldman Sachs predicts credit card losses will continue to climb through the end of 2024/early 2025. What is unusual is that the losses are accelerating outside of an economic downturn, the firm said. Credit card losses currently stand at 3.63%, up 1.5 percentage points from the bottom. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Credit card companies are racking up losses at the fastest pace in almost 30 years, outside of the great financial crisis, according to Goldman Sachs. Credit card losses bottomed in September 2021, and while initial increases were likely reversals from stimulus, they have been rapidly rising since the first quarter of 2022. Since that time, it's an increasing rate of losses only seen in recent history during the recession of 2008. It is far from over, the firm predicts. Losses currently stand at 3.63%, up 1.5 percentage points from the bottom, and Goldman sees them rising another 1.3 percentage points to 4.93%. This comes at a time when Americans owe more than $1 trillion on credit cards, a record high, according to the Federal Reserve Bank of New York. We think delinquencies could continue to underperform seasonality through the middle of next year and don't see losses peaking until late 2024, early 2025 for most issuers, analyst Ryan Nash wrote in a note Friday. What is unusual is that the losses are accelerating outside of an economic downturn, he pointed out. Of the past 5 credit card loss cycles, 3 were characterized by recessions, he said. The 2 that occurred when the economy was not in a recession were in the mid-90s and 2015s to 2019, Nash said. He used history as a guide to determine further losses. In our view, this cycle resembles the characteristics of what was experienced in the late 1990s and somewhat similar to the 15 to 19 cycle where losses increase following a period of strong loan growth and has seen similar pace of normalization thus far this cycle, Nash said. History also shows that losses tend to peak 6 to 8 quarters after loan growth peaks, he said. That implies the credit normalization cycle is only at its halfway point, hence the late 2024, early 2025 prediction, he said. Credit card debt is still a big problem even though the Fed didn't hike interest rates. Americans with credit card debt won't see any relief even after the Federal Reserve decided against hiking its benchmark rate on Wednesday. Their situation just won't get worse, for now. On Wednesday, Fed policymakers kept the range for the federal funds rate unchanged at a 22-year high between 5.25% and 5.5%. But Fed Chair Jerome Powell indicated that the majority of officials expect at least one more quarter-point hike before the end of the year. That means credit card interest rates, which march in sync with the central bank's rate, could increase before the year end. At the very least, they will remain near 4-decade highs for the foreseeable future, troubling news for folks who have piled on debt. Even though the Fed chose not to raise rates in September, the truth is that no one should expect credit card interest rates to stop rising anytime soon, Matt Schultz, credit industry analyst for LendingTree, said. While we don't know what the Fed will do going forward, cardholders' best move is to assume that rates will continue to rise and do what they can to knock their credit card debt. It's certainly easier said than done when life is so expensive in 2023, but it should be the goal, he added. Outstanding credit card balances topped $1 trillion this year for the first time ever, with borrowers undeterred by interest rates that are at their highest level in nearly 40 years. According to Bankrate, the average APR this week was 20.71%. Store credit cards have even higher rates, separate data from LendingTree found, with APRs averaging 30% or higher. The truth is that today's credit card rates are the highest they've been in decades, and they're almost certainly going to keep creeping higher in the next few months, Schultz said. For someone shouldering credit card debt, elevated interest rates can make it harder to pay off balances quickly. Instead, those paying just the minimum could see their balances balloon. There are also recent signs that cardholders are struggling more with their debt. The delinquency rate on credit cards reached 2.77% in the second quarter of 2023, according to the Fed, the highest level since 2012 when it was 2.82%. Last month, over half of credit card borrowers, 51%, couldn't pay off their entire balance each month and let the debt roll over from one month to the next, accruing interest, a separate study from J.D. Power found. That was the first time the share of Americans revolving their debts was higher than the portion who paid their bill in full. You have options, Schultz said. The first step is to ask for a lower interest rate. More than 3/4 of cardholders who asked for a lower APR for their credit card in the past year received one, according to an April 2023 report by LendingTree. Folks who asked got at least 6 percentage points off their April. The fact that card issuers are still willing to give breaks like that, even in the wake of a year of frequent rate hikes, is great news for cardholders, Schultz said. However you slice it, it is well worth your time to make a call. According to Schultz, borrowers may also benefit from transferring their debt to a 0% balance transfer card. They are still available and people with good credit standing can get up to 21 months with zero interest. Those that can, could also consider opening a high-yield savings account, which have also benefited from Fed hikes. You can break the cycle of credit card debt by building your savings while you pay down your debt. Yes, it can be easier said than done, and yes, that means it will take a little longer and cost a little more to pay down that debt, Schultz said. However, once you do, that extra savings will help you avoid going right back into debt over a flat tire or an emergency trip to the vet. According to depositaccounts.com, the average online savings account yield is now 4.39%, up from 3.31% in January and up from 1.81% 1 year ago. The highest online savings account yield is currently 5.30%. Savings account yields are the highest they've been in years, so that money you put away will grow faster than you'd expect, Schultz said. That's one of the precious few silver linings from the past year of rate hikes. Credit card losses can have a negative impact on the economy for several reasons. Reduced consumer spending. When individuals experience credit card losses, they often have to cut back on their discretionary spending to cover their debts. This reduction in consumer spending can lead to a decrease in demand for goods and services, which can negatively affect businesses and lead to layoffs or reduced hours for employees. Increased default rates. Credit card losses typically occur when consumers cannot repay their credit card debts, leading to higher default rates. When these default rates rise, credit card companies may tighten their lending standards, making it more difficult for individuals to access credit. This can stifle economic growth, especially for those who rely on credit for various purchases. Higher interest rates. To compensate for losses from defaults, credit card companies may raise interest rates for all cardholders. This can result in higher borrowing costs for consumers, making it more expensive to finance purchases, such as homes or cars. High interest rates can also discourage businesses from investing and expanding. Reduced consumer confidence. High credit card losses can erode consumer confidence in the financial system. When people lose trust in the stability of the credit card industry, they may become more cautious about their spending, leading to decreased economic activity. Impact on credit scores. When individuals default on their credit card debts, it can negatively affect their credit scores. Lower credit scores can make it harder for people to qualify for loans and mortgages, limiting their ability to invest in assets like homes or start businesses. Ripple effect on financial institutions. Credit card losses can have a cascading effect on financial institutions. Banks and credit card companies that experience high levels of losses may see their profitability decline, potentially leading to reduced lending capacity and less capital available for investment in the broader economy. Systemic risks. In extreme cases, widespread credit card losses can contribute to systemic risks within the financial system. This can lead to financial crises similar to the 2008 global financial crisis, which had far-reaching negative impacts on the global economy. Consumers can run into credit card debt problems for several reasons, often due to a combination of personal financial behaviors, unexpected circumstances, and economic factors. One of the most common reasons is overspending. Many people do not have a budget or financial plan in place. Credit cards often come with high interest rates, especially for individuals with lower credit scores. Unexpected expenses, such as medical bills, car repairs, or home repairs, can force consumers to turn to credit cards when they do not have sufficient savings to cover these costs. A sudden job loss or reduction in income can make it challenging to meet financial obligations. Some consumers may not fully understand how credit cards work, including the implications of minimum payments and interest charges. Social pressure to keep up with friends or maintain a certain lifestyle can lead individuals to spend more than they should, using credit cards to cover the costs. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.